It's good to be back. It's really good to be back. Thank you very much, Patrick, and to the whole Michaels family for hosting us again. I had the great pleasure of doing a road trip with Patrick from Beaver Creek down to Colorado Springs. We did some off-road driving in this typical tiny American car. And I have to say, I mean, we could call him like the Colin McRae or the Carlos Sainz of Switzerland. At some point I thought, okay, that's pretty steep, that's way too fast, but he managed it pretty well and he took good care of us, exactly like he's doing tonight. So, ladies and gentlemen, I'm sorry, I will talk about Koyaanisqatsi today. That's not a new tool by the Federal Reserve, and it's not a new COVID variant or a new rap star. Koyaanisqatsi is actually a term from the Native American tribe, the Hopis, and it means life out of balance. And I don't know if anyone saw this movie. It's from 1982. Anyone out there? No. Yes, Anthony, yes. Well, you either like it or you hate it. It helps to have a good bottle of wine when you watch it. But to me, watching this movie, I really felt somewhat inspired because very often it seems to me that life is completely out of balance. And it's not only life, but also financial markets are very much out of balance. So this is like the leitmotif of today's presentation. But before I get going, I just want to briefly thank our premium partners. As you know, we are publishing this brick of a report for 15 years now. It's published in German, English, in Mandarin, and in Spanish starting this year. We've got this report, we've got 14 chart books, we've got 10 special reports every year, and it wouldn't be possible to put it out completely for free to educate people and investors about sound money, about gold, and about mining stocks without the support of our premium partners. So thank you very much. John, you're one of our premium partners from the very first hour. Really appreciate it. Thank you very much. Now let's get going. Koyaanisqatsi. The Hopi have got a very, very low time preference. They say before you take any decision, consider its effect on the next 7 generations. Well, this is not really what our dear politicians have in mind at the moment. But I think, you know, if you watch the movie, and I highly recommend it, it's really interesting because it shows striking images of nature with urban scenes depicting the imbalances created by modern technology, set to a fantastic soundtrack by Philip Glass. Now, what does Koyaanisqatsi mean? Crazy life, life in turmoil, life out of balance, life disintegrating, and a state of life that calls for another way of living. And I think 40 years later, this film and especially the soundtrack make an apt backdrop for today's investment environment. Koyaanisqatsi neatly captures current market conditions, which are in many ways just a reaction to imbalances. And those imbalances have built up for many years, if not decades, and are now suddenly erupting all at one time and in various parts of our lives. So if you remember one thing for tomorrow, if you talk to your colleagues, you can say, well, this is completely Koyaanisqatsi, and everybody is going to say, wow, what is he talking about? Yeah, you say, this is out of balance. Now, where do we see that life is out of balance? We're seeing it in society. Worldwide, the wealthiest 10% of population are earning about 52% of all income and own between 60 and 80% of all assets, depending on the region. The poorest half of the global population earns about 8% of all income and collectively owns less than 5% of wealth. In contrast, the richest 10% of the global population owns 76% of all wealth. Well, actually, I don't want to sound like a social activist, But I think it's important that those imbalances are, from my point of view, mainly triggered by our monetary system. So if you want to understand the imbalances, the global wealth gap, then actually you have to talk about the root cause, and those root causes can be found in our monetary system. We're seeing that life is out of balance when it comes to civil unrest. According to the World Food Programme, 890 million around the world will go to bed hungry each night. The World Health Organization is telling us that millions of people in Africa are now potentially facing a very real possibility of starving to death. And as global food supplies get tighter and tighter, so will the risk of civil unrest. What you see on this chart is, according to Verisk Maplecroft, a UK organization that analyzes political risk, actually 101 out of 198 countries tracked on its civil unrest index saw an increase in their risk of civil unrest between the second and third quarters of this year. And probably this number will keep rising. And obviously, we're also seeing life out of balance in politics. In the UK, in Iran, we're seeing it, of course, the huge divide in the United States. And, I mean, I love this picture. We're seeing it in the global big political spheres. And we're seeing that life is out of balance when it comes to energy markets. Those are energy costs in percent of GDP, 2020, 2021, 2022. In a nightmare scenario by Goldman Sachs, energy bills would constitute over 20% of EU household gross disposable income. This is up from 8% in 2021. This is going to be 2 trillion of additional costs. Just to compare, ladies and gentlemen, the GDP of the European Union is currently 17 trillion. And life is also out of balance when it comes to currency markets. Actually, if you got the dollar wrong this year, you had a really hard time making up for that. If you got the dollar right, well, basically, that probably saved your portfolio. If we have a look at the price of gold versus the US dollar, obviously, you know, some people were pretty disappointed. From my point of view, the majority of this move can be explained by the strength of the US dollar. But let's have a look at some other currencies. The euro, the Japanese yen, with a massive intervention from the Bank of Japan. Actually, if you want to understand the future of central banking, just look at Japan. They're doing like the 15th round of quantitative easing now. They call it quantitative and qualitative easing. They're doing an enormous amount of money printing with their yield curve control to save their government bond market. And actually, this government bond market isn't existing anymore. There were recently 4 days when no JGBs were trading. And you're seeing it with the British pound also being tremendously weak. Now, from my point of view, perhaps it's not the strength of the US dollar, but rather the weakness of the British pound, the Japanese yen, and the euro. Because relative to the Canadian dollar, relative to the Aussie dollar, or relative to the Brazilian real, actually the dollar wasn't that particularly strong. So from my point of view, it's a very severe weakness of the Eurozone, of the British pound, and of Japan against the US dollar. Now, also in bond markets, we're seeing that life is completely out of balance. Actually, this year for global bond markets is the weakest year since 1865. I don't know, Claude, you were still around at this bear market in 1865? It was a brutal one, wasn't it? Yeah. So I asked him if I could make a joke, and he was he was fine with it. No, but actually, you know, what's happening in the bond market, I think this is kind of under-researched, and everybody is just talking about equity markets and complaining what's going on in equity markets. But this development in the world bond market is brutal. And if you compare it, or if you calculate a so-called balanced portfolio, which is like a 60-40 portfolio mixed between equities and bonds, actually, it's been a really, really tough year. Well, since the year 1928, that's the worst year. On the x-axis, you see the S&P 500 total return, and here you see the performance of the 10-year treasuries. And this is on a real basis, so inflation is actually deducted. Now, what you can see here is that for a balanced portfolio, conservative portfolio, this has been a disaster. And I'm really looking forward to private bankers and pension fund managers coming up with good explanations of that performance. It will be very creative. But actually, that's also a major difference compared to 2008 and 2009. Because in 2008, if you had bonds in your portfolio, they actually saved your performance. In 2009, well, bonds were down, but actually equities saved your performance. So this year is like, you remember the Bud Spencer movies? This Stereowatschen, as we call it in Vienna, this double whammy. So that was tough for most investors. And we're also seeing that the gold market is out of balance. Have a look at the COMEX gold deliveries, the physical deliveries, compared to the long-term average. Since COVID actually started, investors really want to get the physical metal instead of cash settlement. Now, what is, for financial markets, one of the main reasons why markets are that much out of balance? Obviously, it's inflation. And the low inflation world, it basically, this is really simplified, it stood on 3 pillars. First of all, cheap immigrant labor keeping service sector wages stagnant in the US. We had the global economy basically having disinflationary drivers, being the fall of the Iron Curtain and the admittance of China into the World Trade Organization. Both unleashed a massive amount of labor supply on the global economy. I just did a seminar in London and I talked to an Uber driver and he said, well, actually, I'm going back to Poland. There were 3 million Polish people in the UK. He said 1 million is already back again in Poland. We're seeing similar developments with Romanians, with Bulgarians. Those workers are simply missing in our Western world. And in the United States, where you mainly had immigrants from Mexico and from Latin America, this is also slowly changing. The second part, cheap goods from China raising living standards amid stagnant wages. Ladies and gentlemen, we can disagree how much the recent inflation spike was supply-side driven and how much was the result of growing demand. But from my point of view, there is no denying that it was some combination of the two. But overnight, the world went from just-in-time inventory management to just-in-case inventory hoarding. And the third pillar of disinflation was obviously cheap Russian gas, and for the US, cheap fracking oil, cheap fracking gas. So we could kind of say that Russia and China have been the main guarantors of macro peace, providing all the cheap stuff that was the source of deflation fears in the Western world. And this gave central bankers the license for years of money printing. But those 3 pillars of low inflation are now changing. As central banks are done fighting in deflation with asset price inflation and are now fighting inflation with asset price deflation. Ladies and gentlemen, today's inflation is more about supply and less about demand. It is probably much more about geopolitics than about domestic politics. And what you see on this chart is actually one of my very favorite charts because it shows 4 decades of falling inflation rates. So actually, if you're a professional investment advisor, basically, you never experienced an environment of strongly rising and of high inflation. If you're an algorithm, you don't have any clue how to navigate this market. And there are very, very few people that actually know how to construct a portfolio when inflation is a real topic. I did keynotes in 35 countries all over the globe, and the best questions were always asked in Turkey. Because Turkish investors, they are used to a rubbish currency. They are used to high inflation. And for them, owning gold in your portfolio is just natural. And I think that over the next couple of years, this will come back in the Western world as well. We will accustom to an environment of higher inflation. And actually, many people say, well, the policy error by central banks is being made now. From my point of view, the policy error has been made much earlier. We put out a special report in fall 2020 where we warned that inflation is going to be a big concern and that now is the time to slowly start raising interest rates. But actually, it seems that central bankers don't read incrementum reports. Now, ladies and gentlemen, you probably all know that inflation now is the topic. If you meet up with your family, your friends, if you talk to colleagues, everybody is talking about inflation. And from my point of view, what many economists completely misunderstand is the psychology of inflation. James Aitken recently noted, inflation expectations are well anchored when nobody talks about inflation. And by that measure, inflation expectations are becoming clearly unanchored. However, from my point of view, and I'm speaking about the United States now primarily, I think we have, for this inflationary wave, we have seen the tops already. Now, if you have a look at the break-even rates for 2-year or 10-year, they actually made their tops already in spring of this year. And from my point of view, we will see in the United States going forward falling inflation rates. That's because of the base effect, that's because of the upcoming recession, and this is because many of the supply issues are getting solved now. Now, if inflation rates come back down, central bankers can actually say, well, we did it. We killed inflation, and this will give them some leeway to stop raising interest rates. So my call is inflation rates will rather surprise on the downside over the next couple of months. And producer prices seem to have peaked for now. What you can see here is Germany, still up 50%. Good job. In the US, they are already coming down dramatically, but have a look at this gap. I mean, 10% producer price inflation in the US versus 50% in Germany. That's pretty significant. Spain is basically the same. Well, Switzerland also very, very interesting. And from my point, this big gap between Italy, Spain, Germany, and on the other hand, Switzerland and the US can also and strongly be explained by the strength of the US dollar and the Swiss franc. So a strong dollar, a strong franc is like a fitness program for your economy. Now let's have a look at the last inflationary wave from 1966 till 83, and let's compare it to the current wave. If my take is correct, then actually we have seen the tops and we will go lower. And then everybody say, well, inflation is dead. And from my point of view, inflation will reappear. We'll see that labor demands will get higher and higher. From my point of view, on the commodity side, we have seen a huge lack of investments, of capex, and this will come back at some point. But as I've said, for this inflationary wave, I think we have seen the tops. And the economy is also out of balance. While inflation has been the big topic, I think the next big inflation will be the recession that is building up at the moment. Now, sometimes when I really have a hard time falling asleep, I listen to the press conferences of Jay Powell. It helps a lot. But it really sometimes helps to listen to former Fed officials, because sometimes they tell the truth. And William Dudley, the former president of the Fed New York and the vice chair of the FOMC, he said, if final conditions don't tighten on their own, the Fed will have to shock markets to achieve the desired response. It will have to inflict more losses on stock and bond investors than it has so far. So this is actually the so-called reverse wealth effect that the Federal Reserve was referring to. And actually they did a pretty good job destroying capital markets. Well, since the beginning of the year, global equity, bond, property prices are down 60 trillion. That's roughly 60% of global GDP, or more than the combined GDP of the US, China, Japan, India, France, the UK, and probably also Liechtenstein. So we have seen on nominal basis the biggest wealth destruction in the history of mankind. Now actually, I'm not so sure if this reverse wealth effect will work out very well, because we're seeing that consumer sentiment is getting really, really negative. Actually, the last readings were the weakest consumer sentiment readings ever in 70 years of this survey. So this is actually lower than during the Vietnam War. This is lower than during the Arab oil embargo of the 80s, the inflation of the 90s, the 87 crash, the Iraq war, the COVID crisis, and so on. So actually, if central bankers keep telling us, well, is this going to be a soft landing or only a mild recession? Well, actually, the consumer isn't really doing so well. Now, one of the main reasons for that, obviously, is the real estate market in the United States. And as you all know, I mean, Americans are much more concerned or much more interested in the development of real estate prices. Now, mortgage prices have more than doubled in 18 months. And what you can see on US real estate prices, well, actually the market is very, very quiet. There's no buyers at the moment. So actually, we're seeing enormous effects on the real estate market. And we're seeing that the US consumer is still kind of resilient. Now, why is he that resilient? Because actually, consumer loans, credit cards, and other revolving plans are up big time since the beginning of the year. There was a fantastic interview with the CEO of Walmart. He said, actually, purchases at Walmart, he can see that clients are maxing it out. They don't pay with the debit cards anymore. They're paying like for the small grocery shopping with the credit cards. And you can see that development here. So from my point of view, this is one of the reasons why the US economy is still doing somewhat okay. Now, from my point of view, ladies and gentlemen, most of the indicators, like the CPI and also the GDP, they only tell you what has happened over the last couple of months. But as an investor, I want to see what's going on in the future. So I don't really care about lagging or coincident indices. I care about leading indicators. And this is the US Conference Board, which ranks the top 10 economic leading indicators and wraps them in a diffusion index. And you can see it on this chart. Every time the index prints 2 or more times below 0, we are already in a full-blown recession. Actually, this index has correctly forecasted 5 out of 5 recessions since the 1980s. And here is another one that is telling me that this big pivot that everybody is waiting for is coming very, very close. What you can see here is the ISM index. And actually, every time the ISM falls below 50, we saw falling interest rates. Now, guess where the ISM was recently? Slightly below 50. Now, it's not only inflation and the economy being out of balance, it's also monetary policy being out of balance. And I think what people tend to forget is this enormous amount of tightening that we saw since the beginning of the year. It's not only aggressive rate hikes. Just remember, at the beginning of the year, rates were at 0. Now expectations for the first quarter in the United States are at 5%. So this is a huge move. But then we also see quantitative tightening, and we're seeing the strength in the US dollar. So this is basically a tightening on 3 different sides. And if we have a look at the forecasts of our dear central bankers, Jay Powell said, I think we now understand better how little we understand about inflation, which is an utterly remarkable concession. The Fed has only one job and 400 PhDs to help him do that. And Christine Lagarde, she said in December, I see an inflation profile that looks like a hump. We are firmly of the view, and I'm confident that inflation will decline in 2022. Now, my big question is, why do people believe central bankers now? If they've got the worst track record ever, if they would be analysts, if they would be fund manager, they would be out of the markets. They would probably sleep under the bridge. Now, why do people actually believe now that Jay Powell is the new Paul Volcker? Why do they believe now that they're really that hawkish and that you will continue raising rates? I don't really get it. But they've created this narrative of hawkishness. Now, actually, here's a little history of interest rates. And what you can see here is only 3 out of 20 rate hike cycles did not end in a recession. Now, ladies and gentlemen, we've got by far the highest debt levels ever. So we've got the highest sensitivity to rising rates. We've got the quickest rate hike campaign in the last couple of decades. As I've said, rates were at 0 at the beginning of the year. So I think it's not an outlandish forecast that this time around it will end in a recession as well. And on top of that, we've got quantitative tightening. Actually, on an annualized basis, the Federal Reserve will take 1.2 trillion out of the market. It will reduce the liquidity. It is trying to sell bonds into the market. Now, actually, if you have a look at other QT periods, well, this is always the forecast. Well, didn't work out so well. This is the current forecast. Probably in 1 year from now, I don't think we're going to be here. We'll rather be here. And the third thing is obviously the strength of the US dollar. The US dollar being a global wrecking ball. It's a colossal tax on emerging market economies. And every time we're seeing the strength of the US dollar, something happens. Now, I know that the last week was pretty tough for the US dollar, but from my point of view, we're still in a secular bull market for the US dollar. Now, as I've said, the market believes now that Jay Powell is the new Paul Volcker. If you have some time and if you watched Koyaanisqatsi, then I make another recommendation. Read the book, the biography, Keeping at It, not by Jay Powell, but by Paul Volcker. It's a fantastic book. But actually, if we compare the current stagflation to the stagflation of the 1970s, we did that in our last In Gold We Trust report. Many things that were similar, but also that were different. But I think the most important takeaway are the debt levels. We saw on a government level, debt levels at 35%, now we're at 123%. For companies, roughly 50%, now 77%. Private households, 45% on average, now 76%. So this clearly tells me that actually, nowadays, it's so much harder aggressively raising interest rates because debt levels are twice or even 3 times as high as when Paul Volcker was around. And the second major difference from my point of view, Ludwig von Mises said people are complaining about inflation, but they enthusiastically support policies that can only be accomplished with inflation. Well, actually, the political environment was completely different. Jimmy Carter swore in Paul Volcker in 1979, and obviously Carter lost to Reagan in 1980. But what I want to tell you with this picture, Paul Volcker had full support from the government, from the White House. But if we enter a severe recession now, ladies and gentlemen, which is what I see coming, I highly doubt that the Federal Reserve will have the full support of the White House. I think they will be blamed for the recession. So my take is clear. A recession is in the cards for the United States. It will not be as severe like the recession over here in Europe. Now, gold. Is gold an anchor in times of imbalance? Well, actually, life is about expectations, ladies and gentlemen. And if I would have told you 1 year ago that inflation is at 8% and that there's a war in Europe and that gold is trading at 1770, you would probably have said, no way, it's way too conservative. It's going to be much, much higher. So expectations were pretty different. I know that. And it's not only markets' expectations, but also my expectations. And as I've said, expectations are important, as you can see on this little video. So many people I know are completely unhappy, unsatisfied when it comes to the performance of gold this year. But actually, gold did hold up pretty well from my point of view. Given this huge turmoil that I explained at the beginning, this is the worst year for balanced portfolios since 1928. It's the world's worst year for bond markets since 1865. And actually, if you have a look at the so-called world gold price, it's actually very close to new all-time highs. You probably already know this table. It's one of my favorite ones. It's showing you the performance of gold in various currencies. And I think it's important to put it into perspective. As I've said, we're seeing a tremendous bull market in the US dollar. So gold is down 4% in US dollar terms. In euro terms, it's up almost 7%. British pound terms, 11%. In Japanese yen terms, 18%. So I think actually gold has done an okay job this year. And we shouldn't forget that there was this huge tornado, this huge thunderstorm in capital markets. And I think that gold has been a pretty stable shelter in that environment. Now, actually, my take is that the pivot is going to come pretty soon. And we saw the 2018, fourth quarter 2018 pivot. What did gold do afterwards? It was up 18% and it was up 25% the year after. I can imagine somewhat similar development after this pivot. Now, the mood in the gold camp obviously could be better, I would say. Have a look at this chart. It's by Sentiment Trader. Actually, yeah, it's pretty pessimistic. From a contrarian point of view, it's a good setup. Now, in September, when I attended the Denver Gold Show in Colorado Springs, this article came out, Gold Loses Status as Safe Haven. And actually reminded me very much of this article by the Financial Times. which basically nailed the bottom in gold back then. Let's talk about miners briefly. Well, Pierre Lassonde, he once said, back then, attending a gold conference was a lot like going to church. The rooms were mostly empty, with a few old people in the back praying a lot. Now, thanks to Jessica and the great work of the conference organizers, well, it actually changed dramatically and it improved a lot, but still, given the fact that gold miners are highly profitable, what you can see here is all-in sustaining costs versus the average gold price. Actually, mining companies are making decent amounts of free cash flow. And the mining stocks are extremely oversold relative to gold at the moment. I wouldn't really take that as some sort of a timing advice, but still we're seeing for the longer term, relative to gold, which is from my point of view very cheap, mining stocks are, that's one standard deviation. They are below one standard deviation on this ratio chart. And when it comes to seasonality, actually, November is a pretty good time to buy mining stocks. You can see the GDX seasonal average. This is a great chart by Sentiment Trader. And actually, November has by far the best seasonal pattern. December is also fine. And actually, January and February are also pretty good. So the next 3 to 4 months should be really, really supportive from a seasonal side. And when it comes to commodities, ladies and gentlemen, as you know, I really like to understand the big picture. And this is another chart starting in 1915. And you can see the large commodity cycles. Well, actually, I think that we're in a new cycle. And actually, I explained this brutal development that we have seen, recessionary fears. We're seeing that China has basically been closed for more than 2 years. We're seeing aggressive rate hike campaigns. We're seeing a recession on the horizon in the US and in the Eurozone. And actually, commodities were down only 22%, which is, from my point of view, that's a pretty good development, that it actually shows that still there's lots of demand and lots of interest in the commodity space. And normally, what you want to see in a big secular bull market, you will go significantly above the previous top. So from my point of view, I always thought, okay, from a fund management point of view, our kind of strategy was, let's wait for the recession to happen and then really buy big time in the commodity space. But I could see that actually commodities holding up really well and actually keep rising in a recessionary environment. This could further add to the recessionary pressure because, as we have written at length in our last In Gold We Trust report, this bull market is primarily coming from the supply side. We haven't seen any investments in the mining space at all over the last bear market cycle. Now I'm already coming to a conclusion. In our last report we wrote, we believe it is illusory that the Federal Reserve can deprive the market of the proverbial punch bowl for any length of time, and we seriously doubt that the transformation of doves into hawks will last. Most hawks will merely turn out to be doves in hawk's clothes and will shed their hawkish garb sooner rather than later as a result of the inevitable consequences of monetary tightening, recession, rising yields, stock market corrections, bankruptcies, and unemployment. So from my point of view, ladies and gentlemen, the pivot that the market is waiting for, it probably has already started. And what we saw last week, these fireworks in markets, probably are a sign for that. Now, have a look at the price of gold. People keep telling me, well, actually, gold is already too expensive. Well, it's not expensive. You have to take it on a relative basis. If you compare it to the 1980 peak and the 2011 peak, And if you compare the gold price, which was 800, 1900, and is now 1700, if you compare it to the monetary base, if you compare it to M3 money supply, if you compare it to debt, if you compare it to the median house price, to the S&P 500 and the US dollar index, actually you can see that it's very, very cheap. It's almost ridiculously cheap. Now I'm already coming to the conclusions, ladies and gentlemen. So my take is that the secular trend of disinflation is over. We have seen an inflation shock, now a rate shock, and the next shock will be a recession shock and a pivot. But politicians this time around will shield the private sector and offset losses using the government balance sheet. But there has to be a release valve. It's going to be either currencies or bonds. The current wave of inflation will peak soon. Inflation will continue in waves. And the crucial question, when will monetary tightening stop? And perhaps 14th of December, this might be the last rate hike in this rate hike cycle, and then it can go down pretty quickly. Now, ladies and gentlemen, actually, there wasn't only Koyaanisqatsi, there was always also a sequel, Koyaanisqatsi, which was not really overwhelming. But if we want to return to balance, and I hope you understood why I see that so many different parts of our lives are now out of balance, we need to do three things. We have to rebalance, we have to rethink, and we have to renew. And from my point of view, ladies and gentlemen, the international monetary order will be reorganized over the next couple of years. And I think that gold will play a central role in this reorganization of the monetary order. Thank you very much for your attention. I hope you enjoyed it, and I hope there's still some time for questions. Thank you very much.
Ronnie, thank you very much. As always, fantastic. I will go to this side a little bit. Before we start with questions, I have one question. I saw in your Gold We Trust report one chart where you said $2,189 per gold ounce by Christmas. Do you still hold that?
No, you didn't read it correctly, Jochen. I'm sorry.
But I wanted to believe it.
No, but actually, you know, I think people tend to forget we were close to new all-time highs in spring. So it can go really pretty quickly up, but also down. We said 2,198 is the target based on our gold price model. So we put out a 10-year model for the gold price in our 2020 report. And I've been working in the bank for way too long, so I know that all models are flawed. So I wouldn't put too much emphasis on that, but it is a monetary model. And I think the input factors in that model they kind of make sense. And you probably want to hear the long-term target. This is $4,800 by the end of this decade.
Like it, fantastic. There's another thing I was missing in your presentation, because you normally always do that. What are your predictions for next year?
Austria won't win the World Cup.
Won't?
No, we won't.
What a shame.
Because the Austrian national team said, well, we don't like what's going on in Qatar, so we're going to boycott that. Yeah, we're not going to participate, so we're not going there. Well, I usually do those 10 forecasts at the Munich conference, the Edelmetallmesse, and one of the forecasts was example regarding nickel. I'm extremely excited about nickel. I said that actually Bitcoin will go to 40,000. I think Bitcoin will be one of the first assets to really profit from that pivot. I said actually that silver will start outperforming gold over the next couple of months. I was...
You like that, George?
Yeah, so those were like 4 forecasts of that. But you can all read it up on our webpage.
Fantastic, thank you. Yeah, questions? Patrick, do you have the microphone? Yeah, who has a question to Ronnie? Yep.
Thanks, Ronnie. That was a great talk. Just a question related to risk, right? You talked about potentially being a time to position ahead of the recession, but how do you factor that in with the sort of risk-off environment that we're in and everyone chasing the US dollar?
Well, obviously, I think that we're still in sort of a risk-off environment, clearly. And, you know, I spent 2 weeks in the US and I see that it's just on a relative basis, yeah, it's just profiting from the mess that we're facing here in Europe. So I don't really see, I cannot really make a very strong case for, I don't know, for the euro, probably also not for the British pound and so on. So I think the relative strength of the US economy will continue. I think what we saw last week was kind of a short squeeze. I mean, that was a brutal move. And normally you don't see 7% moves in the Nasdaq, for example, in a healthy market. So that smelled a little bit like a bear market rally. But I think that once this pivot really is getting discounted, because now everybody is on this side of the boat, everybody really believes that the Federal Reserve will continue hiking rates. I think if it's going to move, there will be pretty significant developments in capital markets. And we had a look at the last pivot, and actually gold sniffed out this pivot pretty early on. It was ahead a couple of months, actually, a couple of weeks, sorry. And I could see it quite similarly for the time being. But what I really see as the main topic going forward is an earnings recession. I think from a company point of view, we all see that quarterly results are coming in weaker and weaker. So this is really what, from my point of view, most of the strategists don't want to see. They try to ignore it, but actually on a company side, also for US companies, they're feeling the strength of the dollar, especially the international companies. I think that's going to be the topic for the next year.
Okay. Yes? Raphael, just wait for the microphone, please. Patrick, please.
How do you explain that gold is moving from the west to the east? They say the Western world is selling out the gold and it's all going east.
It's happening. I mean, that's a trend that we're seeing for many years now. If you follow, for example, the BRICS, so many countries now wanting to join the BRICS. The SCO, the Shanghai Cooperation Organization, when it comes to their gold production, they're by far the most important gold producers. When it comes to gold consumption, they're by far the most important gold consumers. And when it comes to central bank purchases, it's also those countries. So I think we here in the Western world, we think like we are the center of the gold world. But actually, if you go to Dubai, if you go to India, if you go to China, well, actually, I think the center is more in that direction. So for them, obviously trying to diversify out of the US dollar is a big topic. I mean, on the 25th of February, the Western world basically said, you know, our friends in Russia, your 650 billions are worth nothing. And I think this is for every country that is slightly critical to US policies. This is a wake-up call. And what do you want to hold? You want to hold a highly liquid currency that is accepted all over the globe and that doesn't have any counterparty risk. So actually, I think this is a trend that is going on for many years already, and I think this trend has further strengthened this year.
Mm-hmm. Okay. One more question? Maybe Pascal? Of course. Yeah, that's why he's so skinny now.
So I like Jim Grant's saying, so the gold price is the reciprocal value of trust into central banks. And is this maybe the explanation for the relative strength in the gold? So we have US inflation slows from a high level, but it slows. We have still strong dollar. we have nominal rates rising, but maybe the gold market doesn't really believe in the hawkishness. What's your take on that?
Doesn't believe in what?
In the hawkishness of the
Yes,
Fed.
yes, that's actually my take. And I mean, the theory has been, as the Federal Reserve, cannot really deal with the supply side, they have to destroy the demand side with this wealth destruction, inverse wealth effect. Now, as I've said, down 60 trillion worldwide, and it doesn't include commodity markets, crypto markets, most of the real estate market. And actually, people would say, well, actually, it's just paper wealth. I talked to a very, very rich friend of mine. He probably wouldn't have to work, and I think the next 2 generations wouldn't have to work either. I'm sure they're gonna screw it up and waste the inheritance. But still, he told me, well, actually, if I look at my brokerage account, it's down big time, and I will cancel my membership in the golf club now. Now, actually, does it make any difference for this guy having like 200 million if he spends slightly less? But it's a psychological thing. And people change. They have a look at what's going on, what's being written in the newspapers. They feel less rich and they change their behavior. They change their spending behavior. So from my point of view, it is crystal clear that we're moving into a recessionary environment. And I think then this is going to be the point in time when people kind of lose faith in central bankers, because then they realize, well, actually, it's not a soft landing. And if unemployment goes through the roof, actually, they're going to blame the Federal Reserve. And I think this trust can be broken pretty quickly. I mean, trust it's asymmetrical, yeah? You can be married for 40 years, but then you come home earlier and you see your wife with the neighbor. Well, actually, the trust that was built up over 40 years, it's gone. It's gone. So, yeah, I'm only married for 6 years, so I cannot really relate to that. But you get the point.
That's why we still believe.
Yeah.
Yeah, fantastic. All right. Ronnie, thank you very much.
Thank you.